Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Jay joins us now. Jay, wonderful to see you. Love having you in the studio. Can you talk about just how much in the crystal ball discussions that we've been having about artificial intelligence, why you think the price action shows we're just not bullish enough?
Well, I think the market tells us that, right, with the reaction to the news. The fact that the stock is up 10% on the day tells you it was a positive surprise, just by definition. And so, and it was. I mean, it's super impressive, right? I mean, you have to admit, a tripling of revenue and a sevenfold increase in profits year over year. I mean, that is just, it's unheard of. And so you have a 10% move, and you don't have the rest of the market responding, as was discussed just a minute or so ago. But to us, look, we're believers, right? We are believers that every company, every government in the world is going to have to participate in the AI age. And it's either you participate or you lose. And it's that simple. And there's this concept which we believe in, which is called sovereign AI as an example, which basically states that every country is going to want its own AI. So you're just talking about a massive global explosion of demand, and you're seeing that with NVIDIA.
Although you're seeing it with NVIDIA. Mm-hmm. They're the winner.
Yes.
And it's a question of, can they basically rise all boats, or is it going to be NVIDIA's game and party, and only NVIDIA's game and party, as they potentially take share from AMD, from Intel, from a lot of other companies that otherwise might be getting some of these dollars?
Look, we're believers in what we call the pick and shovel thesis of investing in this, right? We want to be in the digital pick and shovel, and for that means for us rather semiconductors, okay? Because they're needed for the whole process. They're the winners of this, to your point. And whether, X company versus Y company is a different story. To us, it's quite simple. As an investor, we want to be in the pick and shovel. So in the pick and shovel in the digital age is the semiconductor space. And then the pick and shovel in the physical space is the miners, because what's really interesting, and you touched on it with commodities earlier, what's really interesting is you're fusing the digital and physical worlds through the power demands for the data center build-outs. And again, I mean, I think the CEO of NVIDIA is a guy you have to pay attention to. He is at the forefront of this. He's like Elon Musk was a couple years ago with EVs, right? He was on the front end of it. And so he was seeing what was coming. And Musk was right, okay? So now you follow the CEO of NVIDIA, and he's talking about the factories of the future. He's talking about the data centers being the modern factories of our world as we move forward. And they need power. So I'll just give you an example. Natural gas. UNG, up 40% in the last month. 40%. Before that, it was copper. Copper, because you need copper for the electrification and the power generation, which again is going to be global. Every country, every region. So it really feeds into our tripolar world thesis of regional deepening and regional integration in Asia, Europe, and the Americas. And you see it. The Europeans are building out AI. The Chinese are building out AI. The Americans are building out AI. Everybody has to have it, and they have to have it now. And then the last point I would make is that, and I'm a believer in this idea, is that this is going to come much faster. So I respect Ian earlier, and he was saying with AI, he's not sure how it's going to come through. My feeling is that the infrastructure for AI has already been built out.
Right. Well, can I just defend Ian for a moment? Because part of his thesis was for the
internet. Usually there's like nothing but silence. I mean, wait a second. Come on. Where's Jon?
Yeah, Jon. Exactly. I'll take the combative view if Jon's not here. I'll try my best.
That never happens then. I'm like,
my accent isn't keeping up with it, but my combativeness, I'm trying, Jay.
Okay. No, I'm game.
Okay. So Ian's argument is basically that it's not going to be adopted as soon, specifically with companies. Because if you think about the internet boom, everyone and their mother could simply sign up to the World Wide Web, get their own website, and then there you go, you take off. Integrating AI is a much more complicated and longer process.
Okay, the pushback is that it took a decade or more for the internet to be built out because every piece had to be created from the start. The point of the AI age is that it's a layering on. The infrastructure is already built out. And so it's going to accelerate much, much more quickly. So I'm in the it's going to accelerate much more quickly camp. Ian can be in the other camp. We see how it plays out. And I go back to the idea that every company is going to have to participate in this. Every country is going to have to participate in this. And it's a race. And so the money that's being put into this, and again, talked about fiscal earlier a little bit, interest rates, governments and companies are going to spend money on this. Companies are cash rich. Governments are spending. The G7 just came out with their outlook, or the IMF, for fiscal for the next through 2029. No change. So there's no community for significant fiscal cutting. And you have the companies also spending. So and again, NVIDIA is a perfect example. It increased its CapEx, it raised its dividend, it's got a stock split. So there's all these things that are happening because they're making so much money. They made $15 billion in a quarter.
Well, you had Greenspan, for example, back in the 90s, early aughts, talking about the productivity boost, the paradigm shift, basically from the internet age. Mm-hmm. Do central bankers this time around, are they aware of the potential changes to the macro landscape that you're talking about, and they need to start thinking about policy potentially differently because of that?
Yeah, that's an excellent question. I mean, we're believers in what we call the global macro blue sky outlook. So 2023 to 2027, we see a very bullish outcome. And this, what we just talked about, underpins that because we wrote a piece a couple weeks ago called The Age of Investment. We are in an age of investment. So 2010 to 2020 was monetary policy driven. Central bankers ruled the world. Now we're in the space where fiscal policymakers are going to rule the world. And again, it's a recognition that we need sovereign AI. We need to pay for it. We need climate mitigation. We need to pay for it. We need defense spending. We need to pay for it. And so all these things are driving, as I say, we believe an age of investment, which is going to reinforce that productivity gain, which is also being fueled by a fact that we're in a shrinkage of the global workforce, right? So demographically, we're in a whole new world, which we think is going to continue to drive automation, drive robotics, and drive the regionalization of things so that you have a whole reshaping of the supply chain, which is happening in Asia right now with China. I mean, China is basically carving out Southeast Asia, which is the fastest growing part of the world, and they're going to dominate that space. And you just look at what they're doing with EVs in Thailand and Vietnam, et cetera. They're setting up a regional production supply chain for EVs, and they're going to own that space.
Well, I wanted to ask you about China because so much of your thesis, basically the basis is that China is still integrated with the West. Mm-hmm. What happens if it's not?
I don't believe that's going to happen.
But do people actually think we would see what we saw with Russia's invasion of Ukraine within a weekend? You had companies pulling out, their central bank assets locked.
Yeah. Well, I think, look, we've made it clear to China that we want to control their ability to rise on the tech stack. And so they're now coming back to us and saying, fine. And I think that's an opportunity, right? What we call our two tech stack thesis, right? Where the Chinese companies are going to dominate China tech stack. The American companies are going to dominate the American tech stack. That's fine. Investors have cottoned on to the latter. They haven't figured out about the former, right? So you have China tech selling at a massive discount to U.S. tech, even though the China tech space is twice as large, growing twice as fast. And so for us, we want to own the China tech space because that's where the opportunity is. And now you're seeing the same thing with EVs, right? China does not want to, China is integrated into the global trade patterns, right? They have massive trade surplus, they have massive exports. They cannot afford to be cut out of the global trade flows. And so you're seeing that in the reaction, we believe, to Biden's announcement last week about 100% tariffs on EVs. That's huge. But yet there's been nothing from the Chinese because they know they need to keep the Europeans on
Well, they
side.
Signaled they're going to potentially have tariffs.
And they want to do it on the European side. They need to keep the Europeans on side. The Americans, it's kind of already a done deal. So they're threatening the Europeans with big tariffs on internal combustion engine European exports into China. And that's a massive market for the Europeans, and that's where the game is being played. But I believe China will continue in the economy, but the tech stack is being divided up and being closed off on both sides.
Jay Pelosky of TPW Advisory, Tripolar World Advisory. Now, I'm so pleased to say Nationwide's Kathy Bostjancic and Alberto Gallo of Andromeda Capital Management. Kathy, what do you make of yesterday's data in particular? I really want to start with that and how much that has sort of forward-looking indications of goods prices starting to really, go up, reaccelerate.
Yeah, good morning, Lisa. Happy to be with you. Yeah, I think, that's, something that's quite interesting because goods prices, as you know, have really been the positive factor here in the inflation story and have actually the latest data sort of suggested, when you look at CPI, that is, that we had further deflationary pressures. If that starts to temper or we see some uplift, that could really, change the story here. Goods, gasoline prices, obviously, headline inflation, very sensitive to that. And the reason that, again, matters is that we still have this ongoing stickiness in the service side of the economy, whether it's core services or also looking at rental inflation.
And Kathy, this is a reason why people are talking about whether there is some sort of restrictiveness currently in the system. Alberto, you wrote a fascinating note about this, just how restrictive Fed policy actually is and how it's sort of, a mirage that they're using front end of the yield curve to try to seem like they're restrictive, but they're really not so much. Please explain, because to me, this is fascinating at a time where people are pushing back their expectations of a rate cut.
Good morning, Lisa. Essentially, what we're talking about is the Fed trying to perform a magic trick. They have focused the audience attention on the front-end rate, and they've raised front-end rates by 500 basis points. But on the other hand, what they're doing is to reducing the pace of tapering, and they've reduced it by more than expected. So the Fed balance sheet is still, very large, and it hasn't really fallen since the peak. At the same time, there's also a lot of fiscal and there's indirect QE. For example, the bank term funding program has allowed banks to fund cheaply to buy treasuries. So, they're hiking with one hand. They are not hiking with the other. The result is that there is a record loose financial conditions. So we definitely don't see any restrictiveness in financial conditions right now, unless you're a weak household and you're funding with credit cards or auto loans, so you're depending on the front end rate. But for large firms, for whoever funds in the bond market or long-term mortgage borrowers, funding conditions are still pretty good. And that means persistent inflation. It means that there's rates volatility, and we are a lot more worried about reacceleration in the economy or persistent inflation, hurting the rates market rather than the recession that, every economist has been thinking about for the past 3 years.
Well, Alberto, we got a fresh call from Goldman Sachs this morning saying that they now expect a cut to be in September. Initially, most recently, they were talking about July. What do you view in terms of the timeline, given what you're saying about the policy not being so restrictive?
I think here the trade is for next year. Yes, we might have one cut this year. Our forecast is still for 0. But the reality is there's still a lot of cuts that are priced in for 2025. And I think that is wrong, especially with the outlook that we have for elections. We're going to have a lot of fiscal stimulus next year, regardless of who wins. But, there are some scenarios where there's even more fiscal stimulus than the CBO is expecting for next year. So we have persistent fiscal and, the 80 plus basis points cuts that we are seeing in the market for next year are not going to happen in our view. So yes, we might have a cut, but it's going to look like a policy error in our view. And, even other central banks are starting to change the narrative. So we need to learn to live with higher for longer. And there's a lot of asset allocation that has been centered around the expectation of lower rates. And that's going to have to reprice.
Kathy, I know you also think cuts could be delayed in a certain scenario till 2025. But Alberto there is talking about potentially the fiscal impulse we'll also get in 2025. How much harder is that going to make the Fed even to cut next year?
Yeah, I'm not so sure we get a lot of fiscal stimulus next year. Certainly, if we do, then that would delay, or dampen Fed rate cuts. But I think, from my perspective, we are seeing some moderation in economic activity. Right now, it's just the first step. And there's a long ways to go in terms of economic activity and also inflation. But we're still hopeful that we do get some further drop in inflation, particularly we think rental inflation. But the problem is it may be brief, right? Because we've seen some signs of rental inflation picking up and home prices picking up. The problem is there's long lags, right? Typically it's about 12 months. This time it seems to be longer. But so we're hopeful that we do get, further cooling in inflation. I think that's really what matters most for the Fed. And I would agree with Roberto, there's like a tale of two economies going on right now. If you can come to capital markets, you're a large corporation, and you turned out your debt, you're in pretty good situation. But if you're a small business, or if you're a middle income household or lower income, you're a variable rate borrower, you are feeling the pinch. And I think higher rates have had an impact. Look at the housing market. The existing home sales market has been essentially stalled.
And that's potentially part of the reason that small caps, for example, haven't kept up with the gains. Alberto, in this idea that policy is easy, not just because of the fiscal, but because of QT2, the Fed would say to that they are slowing the drawdown of the balance sheet, not because they want to ultimately not draw down as much, but it allows them to do it for longer and potentially ultimately get to a lower level because they can keep drawing down without the risk of any financial accident. What would you say to that?
Well, the first phase has been very easy for central banks because inflation came down thanks to an easing of supply constraints, and also we had a very strong inflow of immigration, of relatively cheap labor. Now, these one-off positives are going to fade. So the first phase of disinflation has been much easier. Now it's, the hard part is what's ahead of us. So we have, less flow of immigration, and we actually have, still supply constraints that are persistent. And there are some feedback loops. So the idea of keeping the balance sheet very large and making it come down very slowly, in theory, looks good. But in practice, what it does is that it keeps financial conditions loose for a large chunk of the economy. So there's no real tightening for large firms, for mortgage borrowers that are long-term. And so I think that the result of higher front end, but also persistent fiscal and a persistently large balance sheet has been that financial conditions are not as restrictive as the Fed thought they would be. And the narrative is changing. I think that some Fed presidents are already taking that into account, which means that, you won't be able to do a lot of cuts. But the other consequence is that eventually some central banks will have to choose between price stability and financial stability. So it is true that it's really good to not cause any issues in the financial market, and no one wants it ahead of elections. But the mandate is also price stability, and I think that there's been a lot of micromanagement of volatility from central banks. We see it in the allocation of risk assets. We see it in the love for credit and for carry that there is in the market right now. We're at record tight spreads, and investors, are essentially ignoring this front end 5% rate because the long end is inverted.
Kathy, would you just say to that Alberto's wrong because it's just a lag? That's actually what we're seeing, not that policy isn't tight enough?
Well, I have some sympathy to Alberto's comments. I mean, certainly financial conditions are easy. Part of that's because the equity market continues to rally so much, and we do have an inverted curve. But long-term rates are higher. I think in terms of the thing about mortgage borrowers, they're still looking at 7% rates. That's quite draconian, especially compared to where we were. And I think some corporations, if they have to come to market and roll over their debt, they are facing higher refinancing costs. But in general, yes. I mean, if you're an asset holder and you're a corporation that has a lot of cash and you termed out your debt, the short-term interest rates are not biting as much as the Fed had thought previously. And I think that is key. And I can see the Fed holding rates higher for longer, and possibly, if need be, would raise rates higher. So I have sympathy to that. I think it just really does depend, though, on inflation. If we start to see inflation trend lower, then the Fed will have the green light to start cutting rates, especially next year.
On this show, just a couple minutes ago, we were talking about deflation, and we were talking about deflation when it comes to gasoline prices. In particular, we had this discussion around the average price going down to $3.29 from the current $3.61 in the United States. Michael McKee is still with us. Mike, I wanted to talk with you about how important that is from an economic perspective, from consumer spending, from what this does to the package of household budget that can go to other things. How stimulative, essentially, would it be if gasoline prices go down significantly?
Well, the change that we've seen so far isn't that significant. What you usually see in terms of gasoline prices is when they go over the previous high, that's when people start to pull back and get nervous because it's something that they really notice. Slight changes, 10, 20 cents either way, they bother them more on the upside. But it hasn't had an impact overall on spending in a while because gas prices have been sort of in this range for some time.
Well, and this is a reason why, Kathy, a lot of people were looking at this expectation that we were going to end up with a really crimped consumer where you had savings running out and you had some of these inflationary pressures, people talking about a commodity shock. None of it materialized. So where are we on that? Do we have a consumer that has run out of savings and is increasingly strapped? Or do we have a consumer that can tap leverage, that has plenty of capacity, and particularly at the higher end, still tons of money?
So I would say more in the former camp, Lisa, is that I do think large portions of the consumer sector is tapped out. They have run down, the $2 trillion worth of pandemic-related savings. They've ramped up consumer credit card use, right? And we're seeing, if you look at the New York Federal Reserve survey, 10% of credit card holders are now seriously delinquent. And you see that also with auto loans, delinquency rising. You typically don't see that when the unemployment rate is, less than 4%. That's usually a recessionary sign. So I do think we're hitting some roadblocks for the consumer. But what's going to matter most is employment growth and wage growth, right? I think now the consumer is really dependent on current income stream to fund spending, and the savings rate's at 3.2%. There's not a lot of extra buffer there for the consumer to run things down.
Alberto, final word?
I think there's some weakness. There's a little bit of cracks opening across the weakest part of the employment market and the credit market too, but it's not enough to create the conditions for a lot of cuts. And in the meantime, outside of the U.S., we see China stimulating, Europe spending. So, global financial conditions are very loose. Commodity prices are going up. We're still, much more worried about the right tail. So things going too well versus the left tail, which is the typical recession risk. So, we're going to see more vol in rates, and maybe we'll retest the highs in yields throughout the year.
Nationwide, Kathy Bostjancic and Alberto Gallo of Andromeda Capital Management. Both of you, thank you so much. A survey from GasBuddy saying 60% of Americans are planning a road trip over this Memorial Day weekend. Other people are going to be flying, and they're going to be going to the airport. Patrick Haan of GasBuddy writing this: while Americans gripe about the cost of gasoline, it doesn't seem that too many are going to be deterred from hitting the road. Great news for those who are planning to travel. Motorists are likely to see more stations lowering prices to $2.99 per gallon or less as the summer wears on. Patrick joins us now. Patrick, riddle me this. What happened with all the people saying we didn't have enough refineries? Yes, we're pumping 13 million barrels a day, but there are supply cuts coming from elsewhere. Gas prices are going to skyrocket during the busiest driving season of the year. Why do you think that's not true?
Well, we've gotten a lot more breathing room here over the last 6 to 12 months or so. It hasn't been U.S. refining capacity, but there have been some global additions. I would point out, though, I think this year in kind of the post-COVID world, a lot of Americans hit the road in 2022. That's why gas prices did skyrocket over $5 a gallon. Things cooled off last summer. A lot of folks hit the road last summer, but I think this summer is also going to skew international air travel. TSA reporting records. Our gasoline demand data, I just looked at it, did shoot up for yesterday. about 11.7% rise from Thursday prior. So we are starting to see Americans fill their tanks. But I don't think gasoline demand is going to be at record levels, though a lot of folks are going to be hitting the road or traveling. They may be doing so via air. Of course, the EV transition is part of that discussion as well, although that has slowed down. No matter, a lot of Americans hitting the road this Memorial Day.
So, Patrick, let's just sit on that for a second, because some people do say this is the sort of understated aspect of demand in the gasoline market, that more people have more efficient vehicles. Even if it's not electric vehicles, it could be hybrids. It could be just cars that get better mileage for their gas. How much is that a factor of demand for the gasoline?
Well, probably a notable one. You talk about the EV transition where people completely ditch gasoline. That's probably a small but rising part of the conversation, especially in areas like California that are looking and pushing incentives for Americans to move into those vehicles. But as you mentioned, look at manufacturers, how they've skewed to plug-in hybrid electric vehicles or mild hybrids. A lot of that. I mean, $5 gasoline. Americans, when they buy a new vehicle, often have the memory of those gas prices. And, a vehicle, buying one is a long commitment. And so a lot of Americans have been looking at some of those more fuel-efficient options in the last couple of years. Keep in mind, too, that like myself at this moment, work from home is still a thing. A lot of Americans still doing that. And that's probably where some of this drop in consumption is coming from, the fact that it's been a very slow return to the office.
If we start inching towards $5 a gallon, what do you expect the White House to do? You know how important gasoline is to them. You have been a guest at the White House when Ron Klain was chief of staff, and they were obsessed with this when prices were spiking. What do you expect the administration to do?
Well, they don't have a whole lot of levers. I know that every American thinks that the White House has some sort of huge lever in the White House, the Oval Office, that controls prices, but there's not a whole lot. I mean, the president can offer things like unleaded 88 or E15 all summer. That's what he's done, right? That's going to be available through waivers via the EPA. But the only other thing really is just to kind of hope and pray that hurricane season isn't going to be as bad as they expect. Now, again, some of the issues with summer gasoline prices come from the fact that the U.S. is very fragmented when it comes to these summer blends that everyone's heard of. To give you one example, refineries have been struggling here in the Chicagoland area. Chicago uses reformulated gasoline, which is different than downstate Illinois, which is different than Detroit. So there's all these different localized blends. If the federal government wanted to do something, they could really simplify the system. I mean, California and Arizona both have their own different blends. It's like, you get a blend, I get a blend. Everyone has different blends, and when refineries go down, that becomes problematic to supply all of these various blends. So aside from that, I mean, the White House already shutting down now the Northeast Strategic Gasoline Reserve. Of course, that was mandated by Congress. Trump tried to do it in 2020. But even that is not going to really move the needle. So the White House is just kind of along for the ride here, hoping that OPEC will continue the status quo and oil prices will continue to be under 80.
What do you think could be a bigger impact this summer? Natural disasters or geopolitics, given we have two hot wars, one in the Middle East and, of course, in Ukraine?
I think without a doubt, I think the weather is going to be a bigger factor. The Middle East, I mean, Iran now has a lot of its own issues with the helicopter and elections coming up. So Iran and Israel, I mean, that was something to watch, but even that didn't really move the needle. I think oil markets are kind of stuck in this depressive state, right? OPEC is now saber rattling. They're going to have a meeting virtually, and oil prices this morning still under $77 a barrel. So I think weather's the big wild card. Nobody controls it, right? Even the Middle East, there's some certainties, even if they're unreliable. Mother Nature's just completely question marks all over it. Will we get a major storm in the Gulf of Mexico? Is it going to be a Harvey and dump, 1 to 2 feet of rain on refineries shutting them down? I think that's really the thing for this summer that keeps me awake. Will hurricane season turn into the dread like everyone's talking about? National Weather Service yesterday issuing its most active early forecast ever for hurricane season, and those sea surface temperatures are rising, and it's quite concerning.
I'll tell you another thing that's keeping people up at night, Patrick, who are on their way to travel. It is the headline after headline about Boeing and concerns about that plane. You couple that with what we're expecting in the airports. It's going to be extremely busy. It's going to be chaos. Do you see any of that translating into folks more wanting to travel via their car rather than going to the airport?
Well, we know Americans have an affinity for their cars, and keep in mind also the headlines over that Singapore Airlines turbulence is probably getting a lot of attention as well. But keep in mind, once you buy those tickets, especially with some of these fares now, you're stuck with it. Oftentimes airlines now have those restrictions back in place. But I think to your point, America still has a love obsession with the fact that cars are mobile. You can leave whenever you want. You don't have to do security. So, yes, I think Americans, if anything, that haven't yet figured out their travel, they'll probably skew more to using their vehicle, especially as summer wears on. Gas prices, we expect, are going to be highest on Memorial Day, lower for July 4, and pending Mother Nature, even lower for Labor Day. So I think that's probably going to open the door for some of those last-minute road trips. As our survey points out, Memorial Day is the most traveled holiday. But if you look at July 4 and Labor Day, plenty of people are hitting the road. They just haven't planned it yet. And those folks that haven't planned ahead are probably going to gravitate towards gasoline consumption. So we could see a little bit of a rebound there, to your point.
Patrick, can you put some numbers on that in terms of what price you expect things to be just heading into Labor Day?
Again, a wide range of possibilities. We have the national average potentially as low as even 329, but as high as 390. August and September are the months that we have the least certainty out of all 12 months that we put our forecast together. August is really up in the air. Why? Because you get a lot of late summer demand. Will we get hurricane season that's more active before? If we don't get any hurricanes, we're probably going to skew to the lower part of that forecast range, maybe 330 to 350. But we've all seen the impact that something like a Hurricane Harvey can have on gasoline prices. And we could skew to the 380s and 390s, or like last year. You'll remember that a spat of refinery issues hit both the West Coast and the Plain States all at once and caused a late summer surge in the national average to 390 a gallon. So we're very mindful of what happened last year.
Patrick, we just have about a minute left. There is a theory that the president can just empty the Strategic Petroleum Reserve and drive prices down. Is that valid?
Well, I mean, that's what so many Americans forget about. We all stare at the price of oil, right? There's a lot of couch analysts who say oil is this, gasoline should be that, but we all forget about the middleman, the refinery, the thing what we've talked about. COVID still, remember, has reduced refining capacity. So you can have all the oil in the world. The SPR could be full. You could release the whole thing. It doesn't translate to usable products like gasoline, diesel, and jet fuel. It still is subject to that bottleneck of the refinery. So that's where the president is relatively powerless. This oil reserve is not going to necessarily equate to lower gasoline prices. And keep in mind, too, when it comes to that gasoline reserve, that thing costs $200 million to maintain over the 10 years it's been in existence. The cost of that gasoline, the street value today of that gasoline, $103 million. So it's probably a good thing we're shutting down that gasoline reserve. I would point out that's something that even President Trump tried to do back in 2020.
Patrick Haan of GasBuddy, thank you so much.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.